Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. This episode is about an investing lesson that I wish I knew when I first started out. But before we get into that, I want to give you a little bit more detail about what inspired this episode. So last week I read a report that 41% of Gen Z investors are using TikTok to get investing information. That's compared to 15% of millennials. Now, as a 33-year-old millennial myself, I don't really use TikTok all that much, let alone to get investing information. But I wanted to learn more. And like anything I want to learn more about, I dive in head first. Let me start off by saying that if you are looking for ways to lose a lot of money in the stock market relatively quickly, then there's more than enough material on TikTok. TikTok should be your new go-to social platform. On TikTok, you learn about the wealth-producing power of penny stocks, how to accurately predict stock prices using charts, and top-secret, very exclusive day trading strategies that someone who has a curfew is using to get super rich. In one video I watched about 10 minutes ago, I learned how anyone can turn their stimmy, which I guess means stimulus check, into 10 grand. Now, all joking aside, all sarcasm aside, none of what I saw makes me think any less of Gen Z as a whole. I like Gen Z. I employ people who are technically Gen Z. I regularly speak at college campuses, and I get to talk to people who are Gen Z. So when I see those videos that I described seeing on TikTok, really what I want to do is just show them a better way. Because I think, like the expression says, if you knew better, you'd do better. Now, all of this came up in a conversation that I had with a friend a few days ago. And after I told him what I just told you, he asked me a great question. He said, if you could go back in time and give a younger version of yourself advice about investing, but you can only give one piece of advice, you can only tell younger you one lesson, what would it be? It didn't take me long to answer. I said I would tell a younger version of myself to think of a stock as a piece of a business. And if I woke up tomorrow with 10 million TikTok followers and I was the most influential person among Generation Z investors, I would tell them the same thing. Think of a stock as a piece of a business. A stock is a piece of a business. While I was watching those investors on TikTok, I actually thought about Warren Buffett. A lot of them actually reminded me of Warren Buffett.
I beg your pardon.
You've gone too far.
Oh my goodness.
How dare you speak of him like that? He is the king. Okay, well, hear me out. Like Gen Z investors, Warren Buffett started buying stocks when he was young. Warren Buffett actually bought his first stock when he was 11 years old. Buffett read every book about investing in the Omaha Public Library. He even memorized stock tickers. And he experimented with a lot of the techniques or tactics that appear to be popular on TikTok. Buffett described this as fun but profitless. Quote, I was hoping that little things in a chart would tell me something about what a stock was going to do. I mean, it was kind of crazy, but everybody else was doing it, so I figured I'd do it too. Everything changed when Warren Buffett was 19. The year was 1949, and this is when Benjamin Graham released his book, The Intelligent Investor. Buffett says the intelligent investor changed the way that he looked at buying stocks. Quote, I used to know, when I was 11 or 12, the ticker symbols of every company virtually on the New York Stock Exchange. But I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide how to value a business and what counts. Here's what Graham says in the book. Quote, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. From the age of 19 all the way to the age of 90, Warren Buffett has lived by this principle. In 1985, Buffett appeared on a television program called Adam Smith's Money World. The host, Adam Smith, asked Buffett what made him different than other professional investors. Why was he so special? Buffett said, quote, they do not really think of themselves as owning a piece of a business. In 1999, Buffett was profiled on ABC's Nightline program. And in his conversation with Ted Koppel, Buffett said, and I quote again, the key to what I do is I look at every share of stock as being part of a business. Warren Buffett's Berkshire Hathaway owns not just stocks, but entire businesses. Some of the names you may recognize are Geico, Duracell, Dairy Queen, See's Candy, NetJets. There's too many to name. So from experience, the approach that he uses when evaluating a business that he's going to buy all of is the winning approach to use when evaluating whether he's going to buy a piece of a business. And that's what Graham was saying in his book. I'm not directly quoting it, but he says that you should approach buying a stock as if you were a private businessman about to buy an entire business, an entire private business. Take that same approach, that same mentality, do the same things you would do if that were the situation. In 2001, during a lecture at the University of Georgia's business school, Buffett said, quote, "Whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it." So there's some things in life you need to spend time figuring out, and there's some things that have already been figured out for you. I'm all for questioning the conventional wisdom. I don't believe in just accepting things because someone says they're true. But this instance, this idea that a stock is a piece of a business, that's just what it is. That's the truth. It's already been figured out. A stock is a piece of a business. It's a timeless lesson, and it's not just a lesson that I believe in because Warren Buffett says so. I want to share some of the ways this lesson has helped me. For starters, viewing a stock as a piece of a business keeps me thinking about the long term. We're long-term investors. Wealth is created through long-term investing. So I don't waste mental energy now worrying about day-to-day price volatility or sell-offs or whether or not we're in a bubble. I focus on buying great businesses at a reasonable price, businesses that I understand, that I feel confident in the underlying economics of. So when things get rocky, as they always do, I don't mess everything up by letting my emotions get in the way. I don't study charts. The only candlesticks that I care about are the ones that, you can light on fire, and I don't even care about those. Viewing a stock as a piece of a business forces me to slow down before I buy something that I'm excited about. I'm going to be sharing more about some of the companies that I just find really interesting that I've learned about through reading 10Ks. You'll be able to learn more about that at cmqinvesting.substack.com. I might also make this a focus of some of the episodes, but again, your feedback goes a long way here, so don't hesitate to let me know. It's Franco at cmqinvesting.com. Send any feedback you have or thoughts you have to that email, even if you just want to say, hey, I'd love to hear from you. The 10K is a must-read. This comes from the 1996 Berkshire Hathaway annual shareholder meeting. Buffett said, quote, "The way you learn about businesses is by absorbing information about them, thinking, deciding what counts and what doesn't count, relating one thing to another. And that's the job. And you can't get that by looking at a bunch of little numbers on a chart, bobbing up and down, or reading market commentary and periodicals or anything of that sort. That just won't do it. You've got to understand the businesses. That's where it all begins and ends." This is such an important idea. And as I said, I wish I had known it sooner. I wish I had applied it sooner. Last but not least, viewing a stock as a piece of a business helps me avoiding selling at the wrong time. It's one of the classic mistakes people make. The disposition effect is something I've learned about through behavioral finance, where people tend to sell winners too soon and losers too late. But the other reason, and I've been in this situation before, is you sell something that you had a reason for buying, but the volatility of the market made you nervous and you just wanted to get out while you were ahead. That happens all the time to people. But having this view and looking at the stock as a piece of a business and doing all the things that are required to do before you would buy an entire business, I just know what I own, and I don't let that stuff affect me, or it doesn't affect me the same way. As I wrote in my notes about Robert Hagstrom's book, The Warren Buffett Portfolio, a company's stock price will eventually reflect the operating earnings of the business. If you have a long holding period, then the price volatility is of little to no concern, so long as the underlying economics of the business have not changed. And when you look at a stock as a piece of a business and you evaluate it that way before you buy it, that's something that you'll know in and out. You will understand the underlying economics. Now, there will always be turbulence on a long flight. The key is to ignore it. Knowing the business, as I said, makes that easy. But here's a great example of someone who is not fazed by turbulence. Charlie Munger. In 2009, he was interviewed by BBC, and the interviewer asked him how much he worries about Berkshire Hathaway's price dropping. And I think at the time it was down quite a bit because, we were in a recession. Here's how much Charlie says he worries about Berkshire's share price dropping. 0. This is the third time that Warren and I have seen our holdings in Berkshire Hathaway go down, top tick to bottom tick, by 50%. He went on to say that any long-term shareholder is going to have their favorite stocks go down by, say, 50%. And he says, quote, "You can argue that if you're not willing to react with equanimity to a market price decline of 15%, 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get compared to the people who do have the temperament, who can be more philosophical about these market fluctuations." I just love how Charlie just rips people, but very dignified, like he doesn't actually raise his voice. You deserve a mediocre result. Just remember that. You deserve a mediocre result. I'm going to say that to somebody. If you're not willing to listen to this podcast, God, you just deserve a mediocre result that you're going to get compared to someone who is willing to listen to this podcast. Viewing a stock as a piece of a business is not just the first principle of value investing. It's also, I think, a product of first principles thinking. Now, Elon Musk did not invent first principles thinking, but he's helped make it a lot more popular. And he describes it as a physics way of thinking where you boil things down to their fundamental truths and you reason up from there. And I can't help but think of that when I think about Benjamin Graham and the principles of value investing that come from The Intelligent Investor. Benjamin Graham laid out the fundamental truths about investing. Any investor who wants to do well just has to reason up from there. And the sooner you do this, the better. And this all starts with seeing yourself as a business owner, because that's what you are. If you own a stock, you own a business, even if it's just a piece of a business. So let somebody else know. Charlie Munger says the best thing a human being can do is help another human being know more. If you know any of these investors who are getting their information from TikTok, show them a better way. Show them compound money quietly. From what I hear, it only takes a couple episodes for people to see the difference in what we're doing. I'm going to end this episode playing the end of the second episode because it just sums up in a really authentic way what we're trying to build here. I appreciate you being part of it. Thank you for listening. My name is Chris Franco. This is Compound Money Quietly. All of us are essentially the managers of our own compounding machines. The purpose of the machine is to put your money to work and allow it to grow into a fortune over the course of your lifetime. The final sum depends on the number of years you invest, the amount of money you invest, and the average annualized rate at which that money is able to grow uninterrupted during your investing lifetime. Now, the CMQ in CMQ investing stands for, as you know, Compound Money Quietly. Compound Money Quietly is the big idea that works in investing. The name itself is a reminder. It should help us think rationally about what we're trying to achieve as investors. It's a call to action. It's what you want to do. Compound money quietly. Let your money compound. Tune out the noise. And on that note, thank you for tuning in to Compound Money Quietly. I appreciate so much your feedback, and I will continue to incorporate it to help make these better and better so that they're useful for you. My name is Chris Franco. Thank you again.